Anyway, function influences form. So we know closeness to debt covenants, bonus targets, reasons to increase revenue. You guys should be starting to build up a list of reasons why management would have incentives to manipulate assets, revenue, and we'll talk about liabilities from 2 weeks' time. So you should start to have a sense. Why would you want to push assets up or down? Why would you want to put liabilities up or down? Same with revenue. Role for regulation. And I know we're talking about this, and this is probably about one of the last times we'll explicitly put a lot of these slides up. Management could be telling us completely unbiased, and that's what efficient choice has been. They are not biased in the determinations they're making. Qantas, what they're telling us, that could actually be the state of play. Like what they're doing, there's no bias in terms of how they're compiling those numbers. This is just the net assets of the business are $6 billion. Or there could be opportunistic choices. There's a reason why they are telling us what they are telling us. Are they trying to keep their own jobs? Are they trying to keep share price up? Well, that seems to be failing. Are they trying to do other things? I don't know. But are there other reasons which could prompt them to do this? We are unable to differentiate between the two. Regulation will help limit that accounting policy choice so we can hopefully see what's going on with the business. Now, what I want to have a look at now, and this is the first time I've done this semester, is actually focus on a particular company, well, other than Qantas, and look at issues where there have been accounting problems in the business. And just point out that some of the things we're talking about, okay, to actually make it happen in the business, yeah, like I'm not saying it's an easy thing, but the actual underpinning idea about what they're doing is actually not that difficult. So WorldCom was a company, you don't have to get a lot of this down, I will be making these available, probably not tonight, but they will go up. Started in the early 80s, collapsed within 20 years, but in that time, it became one of the biggest American telcos. So it grew enormously, and that growth wasn't organic. Like you just can't grow that quickly in that space of time. It grew primarily through acquisitions. And it wasn't funding those acquisitions with cash, it was funding those acquisitions, and the consideration for those acquisitions was its own stock. So it needed to make these acquisitions, to be able to keep doing them, it needed to keep the stock price up. And so what we've got there is the incentive WorldCom had. It needed to keep its stock price up, which meant it needed to keep its profitability going and going well. And it did a whole bunch of things. And one of them, we talked about this last week and it's in one of the incentives, just simply record an expense as an asset. And it did that in 2001 to the tune of nearly $4 billion. Like literally just went, this should have been an asset and just got away with it should have been an expense and got away with calling it an asset. That saves you $4 billion in profit. Like that's, again, how they went about doing it and how they managed to get past the auditors, all those things, that's not really for what we're talking about here and now, but they managed to do it. Cookie jar reserves are another thing which we will talk about in week 7 when we talk about provisions. Not surprisingly, that is explicitly excluded in the standard in relation to provisions in Australia. So you cannot, under IFRS and AASBs, you cannot do that. And we'll show why in a couple of weeks' time. This is really neat. If you've done ABC, or if you're doing ABC, one of the first things you do when you make an acquisition and you're working out at least the accounting for it is you do the acquisition analysis. And basically you work out what it is you paid and what did you buy, so the fair value of the net assets. And in this acquisition of MCI, which I have no idea what it is, obviously quite a large acquisition, of $3.5 billion of that, they were able to deflate tangible assets in relation to MCI by nearly $3.5 billion. Now that means they still end up they still paid the same amount, and the amount of assets they bring onto the books is still the same amount, at least onto the consolidated books. But what they've effectively done is just switch. So by deflating the tangible that they bring on, it just increases the amount of goodwill that is going to be recorded. And the reason they did that is the tangible assets depreciated over 4 years, or on average, while the intangible assets are depreciated over 20. And if we actually work out the dollar effect of that, we can see why they did that. So, need a piece of paper. Oops. So if you depreciate $3.4 billion over 4 years, it's about $850 million a year in depreciation. If you do that by over 20 years, it's $170 million a year in depreciation. So what they should have shown over those 4 years was 850, 850, 850, 850, and then for the remaining 16 years, or however many years left to go, it would be zero depreciation. So that obviously has a negative profit and loss effect. What they were able to do by converting these from tangible to intangible assets is only show $170 million a year in depreciation, but that would then continue for the remaining 16 years that those assets were around. So in these first 4 years, they've actually boosted their bottom line by nearly $700 million, just simply by changing it from a tangible asset to an intangible asset because of how the depreciation would work out. They're obviously going to be worse off in the remaining years. But, it's like 5 years away. That's an eternity. Like, we're going to be better off in the next 4 years, and we'll figure it out down the track. And that is a really good case in point of an horizon, but that's a good point of an horizon. That doesn't sound right. A horizon problem. So even though the total amount of depreciation will be the same, the earlier effect is much better in terms of profit and loss if they choose to do it over 20 years. So there is a benefit potentially from management to making their profit look better, and that can affect their stock price and a whole range of other things. Hit the right button. We haven't really talked about margin loans. I left this in, but the CEO also had a huge amount borrowed from the company, nearly $350 million, all to buy shares in the company. So in effect, it was a margin loan. As problems start to hit, stock price starts to decline, margin calls get made. If you don't have the cash ready to pay off that loan, you've got to sell down stock to be able to pay it. If the CEO of your business is selling down stock, that if you're jumping huge amounts in the market, that's probably going to depress the price. Plus, you have to announce those sales to the market. And if you see that the CEO of your business is selling stock in the business, it's not that great a view. So you'll probably see that have a negative effect on market price as well. And as market price keeps getting depressed, more margin calls get made, and you see that problem just continue. Same thing happened with Eddie Groves and ABC Learning in Australia. He had a huge amount borrowed against the stock of his business. As ABC Learning's price started to drop, margin calls got made on him. He was starting to have to sell stock, and it just cycled all the way down. And that's, again, not a good place to be.